So the next topic we need to cover is NOLs, or net operating losses. Before we start this, I'm just going to point out that the tax laws for net operating losses changed in 2018. We're still going to use the old method because it's still relevant. I'll talk a little bit about the new method after we cover the old method. All right, so a net operating loss just means that a company reported negative taxable income in a particular year. So if it reports negative taxable income, it won't owe any taxes in that period. Tax law, though, does allow a company to take that net operating loss and use it to offset taxable income, either in a prior year, in which it's going to be refunded some income taxes, or I can carry it forward into a future year to offset profits in the future, so it'll pay less taxes. Right, so if it carries it back, it's called a NOL carryback. If it carries it forward, it's called a NOL carry forward. So if a company decides to carry back the loss, it can offset it against the prior 2 years. It's going to start with the earliest year first. Afterwards, it can then carry it forward for the next 20 years and offset it against positive taxable income in future years. If a company decides to carry the loss back, it will ultimately receive a refund of its income taxes in those years. As I just mentioned, a company could also carry the loss forward, so it can offset it against future taxable income of up to 20 years. If it decides to offset against future taxable income, it creates a deferred tax asset, and we account for it in a very similar manner to other DTAs. Right? So we don't distinguish between DTAs from temporary differences and DTAs from loss carry forwards. It's all going to go into the same account. And then finally, a company could elect, instead of carrying back the loss, they can just carry it forward into future years. So let's take a look at an example of an NOL carry back and carry forward. Assume Nguyen Corporation had taxable income of $45,000 in 1998, $30,000 in 1999, and $20,000 in 2000. Nguyen then had an operating loss of $80,000 in 2001. The tax rate is 40% in 2001 and beyond. It was 35% in 1999 and 2000. Nguyen elects to first carry back the loss. So in this case, we have this $80,000 loss in 2001. Since Nguyen's electing to carry back the loss, it first has to carry it back to the earliest of the 2 years. So it can carry it back 2 years. It starts with the earliest year first. So it's going to offset this operating income of $30,000 in 1999 first. If there's any loss remaining, it can carry that loss forward into the next year for $20,000. Right, so pretty much, since they're carrying back this loss of $80,000, they're going to get a refund of the taxes they paid in 1999 and 2000. Right, so they get to offset this income here for 30 and 20. We'll multiply this off, or we'll multiply the 30,000 by the tax rate of 35%. Same thing for 2000, since that was a tax rate in those years. Right, so if you take the 30,000, multiply by 35%, we're out to 10,500. 20,000 by 35% is $7,000. So in total, they would get a tax refund of $17,500. Right. So for the carryback, they've offsetted $50,000 of the $80,000 of loss. So the other $30,000 of loss, they can carry forward up to 20 years. All right, so they have a loss carry forward here of $30,000. If we multiply that loss carry forward by the tax rate at that point, which is 40%, then we get out to a DTA of $12,000. So here we have two assets, essentially. We're going to get refunded our taxes of $17,500. So we have income tax refund receivable for $17,500. And then we have this deferred tax asset, or DTA, of $12,000. So we record these in two separate journal entries. So we're going to debit DTA for $12,000. Now, the other part of these two journal entries should explain why we're getting this income tax refund receivable and this DTA. So this income tax refund receivable, we're going to get this due to a loss carryback. So we have a benefit due to loss carryback for this amount, and that'll be our balancing credit. And then for a DTA, we're getting the DTA due to a loss carry forward. So we have a benefit due to loss carry forward of $12,000. Instead of making the debit or the credits here to benefit due to loss carryback or carry forward, we could also just directly credit income tax expense. All right, and so that's what the top half of this next slide is showing. Again, these benefits due to loss carrybacks and carry forwards, they're going to reduce our loss in the current period. So on our income statement, we're going to list our income tax benefits. It'll offset our operating loss before income tax. So continue on from the previous example. Now let's assume that Nguyen Corporation reports operating income of $50,000 in 2002. The tax rate is 40%. So again, in 2001, we had this $80,000 loss. We carried $50,000 of it as a loss carryback, and then that means there's a remaining $30,000 to carry forward. All right, since we're reporting a income of $50,000 in 2002, we're going to use up the rest of our loss carry forward of $30,000 in 2002. So that'll bring our taxable income out to $20,000. If we multiply taxable income by the tax rate of 40%, we're out to our income tax payable of $8,000. So we're going to debit income taxes payable for $8,000. Now previously, for the loss carry forward, we recorded a DTA of $12,000. Since we're using up all of the loss carry forward, we're going to reduce our DTA balance to 0. So our desired ending balance is 0. Then we'll make a credit to our DTA for the $12,000. And then to finish this off, debit to income tax expense for $20,000. So our debits equal our credits. All right, so this is your journal entry here. Again, for the income statement, this income before income tax of $50,000 is given to you on the previous slide. In the journal entry, we just said we recognize a total of $20,000 in income tax. So that's where this $20,000 comes from. $8,000 of it is currently due to the IRS. So that's our current balance. And then the other $12,000 was from our deferred tax asset. So that's where this $12,000 comes from. The last thing we need to cover with respect to NOL carrybacks or carry forwards, or rather just the carry forward, is the DTA valuation allowance. So earlier we saw that if we have a carry forward, we made this journal entry here. Right, so we're increasing our DTAs due to the carry forward. Earlier we also talked about that in order for a firm to take advantage of a DTA, it needs to report taxable income, positive taxable income in the future. All right, so same thing, if a company has a carry forward, if it doesn't expect to actually take advantage of the DTA, it needs to establish a DTA valuation allowance. So let's look at the same example we were using earlier. We're just going to extend this so it includes a carry forward with a valuation allowance. So again, we had $45,000 of income in 98, $30,000 in 99, and $20,000 in 2000. 2001, they had $80,000 loss. They carried back first. So they offset this $30,000 and $20,000 of income first, which leaves another $30,000 of the net operating loss to carry forward. All right, so the slide's exactly the same as the one earlier, and this slide for the most part up top is as well. All right, now let's say that Nguyen determines it's more likely than not that the NOL carry forward will not be realized in its entirety. As a result, right, we need to record the following entry. So in this case, this is the journal entry we made here to carry the DTA forward. So we have a total 12,000 in DTA. If we expect not to realize it, we need to reduce our DTA by this $12,000. Again, instead of directly reducing the DTA balance, we will credit a DTA valuation allowance for that $12,000. And then we're going to debit benefit due to loss carry forward. In other words, we've made this journal entry to carry it forward. If it's not going to happen, we'll just reverse the journal entry. Right, so then let's carry this scenario forward a little bit more. And let's assume, contrary to expectations, Nguyen reports operating income of $50,000 in 2002. Thus, it's going to realize the tax benefits from the NOL carry forward. Tax rate's 40%. So previously, we've already, in some sense, written off the DTA since we expect not to benefit from it. Now, since that we're actually going to benefit from it, we need to now reverse this journal entry again. So in the case that the DTA is realized after being reduced, or trying to think of a good word for this, or after so previously we made this journal entry here because we expected not to realize the NOL carry forward. Now we're realizing in 2002 that we are going to realize the NOL carry forward. So the first thing we can do is we'll just reverse this journal entry here to reflect that we are going to realize the NOL carry forward. The second journal entry we'll make is to record our income taxes at the end of 2002. So this first journal entry you see up here is the same journal entry that we saw 3 or 4 slides ago. So nothing's changed there. Right, so I'm just going to put this down so we can see the effects on the income statement. So if we look at this income statement here, again, we had income before income tax of $50,000, which was given to us. Our income tax expense in the current period is ultimately only going to be $8,000. Right, so this benefit due to loss carry forward, as I mentioned earlier, this is going to reduce your income tax expense. So we could have also credited income tax expense here. So if we're keeping a T account here, we have plus 12,000 or plus 20,000 minus 12,000. And then since our DT increased, this increases income tax expense by 12,000. So again, this current balance here of 8,000 is for our income tax payable. Again, this reflects what's currently due to the IRS. This $12,000 decrease in our DTA also increased our income tax expense by $12,000, as reflected in this journal entry. And then this first journal entry we made, the benefit due to loss carry forward, decreases income tax expense by $12,000, which is what you find here. Now, earlier I mentioned that these NOL rules that we just went over are the old rules that were effective before 2018. These rules are still relevant though, because if an NOL or a net operating loss was created in a tax year before 2018, it's still subject to the old rules. If the NOL is created after 2018, then it's subject to the new rules. I'm not going to expect you to know the new rules for this class. You should cover those in your tax class, but just to give you a brief rundown, under the new rules, you can't carry back any losses. You can only carry them forward. However, now you can carry them forward indefinitely. And then the second change is simply the NOL can only offset 80% of taxable income in any given year. Other than that, the carry forwards will work pretty much the same. So I'm not going to ask you too much about disclosure in this class. However, you should know that income taxes payable is the amount of taxes currently due to the IRS. So it's a current liability. If a company has an NOL carryback and it has income tax refund receivable, this is again a current asset. And then finally, if a company prepays any of its income taxes, so if they make periodic tax payments, this is also a current asset. For your DTAs and DTLs, theoretically, where they should be classified will depend on when they reverse. The FASB said, however, determining when a temporary difference reverses is really difficult. So currently, DTAs and DTLs just are thrown into a non-current section. For this class, we only really dealt with one DTA or one DTL at a time. If a company has both, they're going to keep track of both DTAs and DTLs separately, but then on the balance sheet, they'll offset these against one another and then just report what's remaining. So for example, if a company had a DTA of 100,000, DTLs of 50,000, 150,000, that means in total, if they offset these against one another, they'd have a DTL of 50,000. So on the balance sheets, they would just report this $50,000 DTL. These next few slides, I'm not going to ask you about. You can look over them at your own time. And then the final part of this chapter is just an example with multiple temporary differences. I'm not going to test you on this on your exam because this takes quite a lot of time to go through. However, you're more than welcome to look through this on your own time.